Welcome to Chapter 18, the evaluation of portfolio performance. In this chapter, we're going to talk about, at the end of an analysis period, how do we decide whether a portfolio outperformed its benchmark, whether, if it returned a 12% return, whether or not that 12% return was worthy of having to pay the active fund manager's salary and bonus. So this chapter is about active fund management. You remember earlier in the semester, I talked about how there's much evidence out there showing that investors, the majority of us, should be passive investors, meaning possibly invest in a mutual fund that is an index fund that simply mimics something like the S&P 500 index. This chapter is about active fund managers, which are the Wall Street folks who sell the story that give me your money, I can invest it for you better, decide which stock should be in the portfolio. So these are the anti-indexers, if you will. They're also the group who have been shown over and over again to not be able to actually outperform a passive index mutual fund. Talk about the two main questions that investors should be concerned with whenever they evaluate their portfolio. We'll explain what it means to say that something is a risk-adjusted measure of performance. We're going to talk about the Sharpe ratio, the Treynor ratio, as well as others. We're going to talk about the Jensen's alpha measure as a measure of portfolio performance. We'll also tie that directly to some of the asset pricing models that we learned about in previous chapters, like the APT, the Fama-French 3-factor model, 4-factor and 5-factor models. We'll describe the Sortino ratio. We will not talk about the information ratio, but we will cover the Sortino ratio and talk about how it differs from the Sharpe and the Treynor measures. Okay, so after some time period, right, an investor would want to know how exactly is their investment portfolio doing. For example, I'm a finance professor, so I know better than to really pay attention to daily market fluctuations. That would only lead to me having to stock up on Pepto-Bismol or other stronger medications prescribed by a licensed physician, of course. So I don't look at that. I'm old school, so I get my paper statements in the mail quarterly. So 4 times a year, I open that envelope, right? And I look at my retirement portfolio and I look at how it did. But retirement is years away, so I'm not changing a damn thing I do with my money every time I get paid. I religiously commit dollars to the retirement account, right? And then watch it grow, compound interest over time, which you've learned about in other classes. So at the end of every period, let's say a year, right? Investor wants to know, how is my retirement or investment portfolio doing? So they measure their actual return, right? So there's an actual return. This actually happened over the last 12 months. Now, remember that this chapter is talking about active managers. So the Wall Street pros who say, give me your money, I'm going to charge you higher fees than if you just put your money in an index fund like Dr. Bray does. But charge you higher fees. But the idea is that investors would be willing to pay those higher fees if the manager was excellent or superior, right, to an index fund. The research, the evidence is not in their favor, but there are still people who always want to be better than average, right? And especially wealthy people, they always want to be the best of the best, so they're willing to throw their money at actively managed funds and pay those higher fees. So the actual return that an active manager produces over some investment period, horizon, can be split into two things. The return that should have been earned given the risk level of the portfolio, so given the money that was invested and the risk level of the overall portfolio, and an incremental return due to superior investment skills. We will call that alpha. Right? Remember I mentioned alpha earlier in the semester. Alpha is the actual return minus what you expected, right? So if we look up here, the actual return are these two things in total. Number 1 is the expected return given the risk level you took on, and 2 is going to be the difference between actual return and expected. So if you remember, if you take actual return and you minus expected return, you will get alpha, right? Positive alphas rule, negative alphas possibly get you fired. Definitely investors will leave you. And we'll talk about what that means here in a little bit. There are three ways investors can estimate expected returns. The average contemporaneous return to a peer group of comparably managed portfolios. That's how it was done before the 1960s, right? In fact, I'm not even going to teach you that. It is in the book if you wanted to go and look at it. And before I forget, this chapter is very long. We are only covering the first part of it. The chapter is very, very long. You can go and learn all kinds of things about portfolio performance. We just don't have the time, right, in a semester to do that. So number one, I won't cover with you, but it is pre-1960. You just go and kind of look at what your peer group did, maybe someone else who manages a large stock or a large market cap portfolio of stocks, right? And then look at their return. How did you do next to your peers? The contemporaneous return to an index, we talked about this in that stock index chapter, right? We use them as benchmarks. That was one of the reasons for creating these index funds, right? What would I compare my retirement portfolio to at the end of the year? The S&P 500 index. That would be the benchmark. The return estimated by a risk factor model, such as the CAPM or those multi-factor models that I taught you, right? Fama French 3-factor, 4-factor, and 5-factor come to mind. So we can estimate them using those, right? Running a regression and computing the expected returns that way, right? That was the APT general form. Okay, there are two main questions, right, that investors will answer whenever they're looking at the performance of their portfolio, right? How did the portfolio manager actually perform, right? So how was their performance during the time period of analysis? That's the part of the chapter we are going to cover. And then once you determine how the portfolio manager actually performed, why did the portfolio manager perform as he or she did, right? What can we attribute, right? Was it skill? Was it luck? Were there certain investment strategies that they used during the time period of analysis that led to this actual performance, right? So the rest of the chapter is quite lengthy, goes through this part, which we will not cover together, right? All right, so that's how the chapter unfolds. Okay, so we are going to go through most of these things. The first one is the pre-1960 version that I said we won't cover, so we won't cover that together. That's the peer group comparison. We will talk briefly about portfolio drawdown, but these are the ones that we'll spend the majority of our time in this chapter discussing. Sharpe, Trainer, Jensen's Alpha. You can put a line through information ratio. We're not going to do that one, right? Information ratio is out, but we will talk about the Sortino measure. Modern finance really isn't that old. I mean, economics, the study of economics is much older than modern finance. In a few chapters, we talked about Harry Markowitz and modern portfolio theory. That was in the 1950s, right? So we knew that there was this thing called risk. I mean, people knew whenever they looked at their retirement balance that things went down. That's called risk. Uncertainty, right? Also called anxiety. We just didn't know how to quantify it until Markowitz came along and came up with the sigma-port equation. Remember the standard deviation of the portfolio? It was a long algebra expression your professor required you to compute to get points in the course, right? And so that's, in the early 1960s, the decade after that, remember the CAPM was developed, and then the tail end of the 60s, the arbitrage pricing theory, Stephen Ross came along and started poking holes in the CAPM, right? So that's really, that's less than 100 years ago. What is that? 50s till now, 70 plus years ago. That may seem like a hell of a long time to mostly younger folks listening, but it's not in terms of an actual discipline, right? No single measure combined both return and risk, right? So before 1960-ish or late 1960-ish, there was no combination of these two in a performance measure, right? And we're going to talk about those. So then that's where Sharpe and Trainer came on to the scene. These two factors had been considered separately, right? What was the return? Okay, so then we just compare our returns to the returns of our peer group. That has nothing to do with risk. What's our risk measure? Okay, we just look at our risk measure over here. That has nothing to do with return. Well, naturally, we want to combine those two, because if I invest my money in a portfolio of small company stocks and my neighbor invests in a portfolio of large company stocks, I took on more risk. Smaller stocks are riskier than larger stocks. Remember, small and large means their market cap or their market value. P times Q. Stock price currently times number of shares outstanding gives you the size of the firm. We've covered that. Okay, so one way people measure performance against other, amongst portfolios, investment portfolios, is this thing called the portfolio drawdown, right? The portfolio drawdown measures how well, right, the investor protected the portfolio against losses over time, right? The maximum drawdown calculates the largest percentage decline in value from peak to trough during some time horizon, right? Wherever that time horizon is, right? So we would look at two portfolios. Your textbook gives us Exhibit 18.3. Okay, so in the textbook, they provide this portfolio drawdown example for you. We have Portfolio Manager A, so this is a human being managing. Your book tells us that these are both of these, Portfolio A and Portfolio B on this slide, are large cap growth portfolios. So these have large stocks that are from firms that are considered growth firms, right? Growth firms would have low book to market ratios. We talked briefly about that. I know we talked for sure more than once about the size of the company and whether or not it was a value or a growth firm in passing. Remember, in the Fama French factor models, that was the HML risk factor on the right-hand side of the equal sign. HML was high minus low. High book to market ratios, which are value firms, minus low book to market stocks, which are growth, right? So both of these portfolios have similar types of stocks in them, and that's good for comparison reasons because then it's more apples to apples. So what they do is they measure the two portfolios' performances over about, looks to be 41 months, right? So the investment horizon we're looking at is about 41 months. It's showing us the graph for every dollar invested under Fund Manager A. So Fund Manager A manages this active portfolio of large growth stocks. This $1, your textbook tells you in the paragraph, this $1 turns into $2.14. So you could write 2.14. Okay? Down here, for every dollar invested in Fund Manager B's portfolio, that dollar turned into $2.10. So you could jot down 2.10. Now, I don't know about you, but when I invest my money, I care about my ending balance. If I'm not going to be using the money during this 41 months, I personally don't care how we get there, but I want to get to a bigger ending balance. So this one was 214 and this one was 210. So I prefer more money over less. This is investments. So Fund Manager A would be, better for me, but we're talking, it's very easy in investments to look backwards. We're looking back 41 months. The future is the scary part. That's the uncertain part, looking forward, right? They show you and they talk about, so here's the maximum drawdown for Fund Manager A, right? The portfolio fell in value 18.6% during this time period. And around that same time, this portfolio only fell 15.4%, right? So your textbook concludes that, what do they say here? They say, Manager A appears to have exposed the investor to a somewhat more volatile investment path. They're saying that because there was a drop in the portfolio of almost 19% relative to almost 15%. Again, personally, I don't care about these drops in value along the way. I'm not touching the money. So I want the money to grow to the highest ending balance. I'd pick manager A. I won't ask you a judgment question while you're being graded. So now we're to the part of the chapter where we're going to talk about these risk-adjusted performance measures, right, for actively managed funds. We'll do Sharpe, Trainer, Jensen's Alpha. We will skip the information ratio. We're not doing that. And we will talk about the Sortino measure. All right, the first one is called the Sharpe ratio, right? So, or the Sharpe measure, same thing. It's a performance measure. It's a relative performance measure. I'll talk more about that word in a moment. Right, so this says the performance measure seeks to measure the total risk of the portfolio by using standard deviation of returns. Remember, we had this discussion earlier in the semester. Sigma, which is standard deviation of returns, measures total risk. What two types of risk make up total risk? Unsystematic risk, which we can diversify away, and systematic risk, which we cannot diversify away. Right? So Sharpe, in his measure, used sigma in the denominator. That's our risk measure. So as we stare at this, what does this say? That's the average return to fund I. Notice I'm saying fund, F-U-N-D. That's like a mutual fund. That is a portfolio of investments, right? So the average return to fund I minus the average return on the U.S. Treasury bill during that same time period, right? We have to be fair. So whatever the average return, whatever historical data we use to get the average return for a mutual fund or a portfolio, we also have to use that same time period, historical time period, to come up with the average return on the Treasury bill rate, the average risk-free rate, right? You divide that by standard deviation of the portfolio or the fund, right? So stare at this. The good stuff is in the numerator. The scary stuff is in the denominator. Investors invest for returns. The higher the return, the better. We want standard deviation, the risk, to be as low as possible. So we want the numerator to be as high as possible. We want the denominator to be as low as possible at the same time. That would lead to a super high mathematical ratio. So we want, in general, our Sharpe ratio to be as high as possible. Perfect. All right, so now let's do an example using the Sharpe ratio. It says, suppose during the most recent 10-year period, so we're looking backwards 10 years, right? A decade. The average annual total rate of return, including dividends on an aggregate market portfolio, such as the S&P 500 index, was 14%. Okay, so that's the average annual total rate of return. So this is R bar, right? Well, R bar sub M. M stands for the market, right? It's going to be 14. And they tell us the nominal rate of return on government T-bills. That's going to be RFR, bar, right? Bar is on top, is 8%. Standard deviation of the market portfolio, that's going to be sigma sub M, right? Was 20%. So they're giving us the market information here and the risk-free information. All right, now they want us to compute the Sharpe ratios for fund manager D, E, and F, 3 separate portfolios. Here's their average annual rate of return. These are the R bars, right? So this is R bar sub D, R bar sub E, and R bar sub F. This is sigma sub D, sigma sub E, sigma sub F. This is the total return measures for the portfolios. Okay, so they've converted everything to decimal, right? Here's the Sharpe ratio for the market portfolio. That's S sub M. There's its R bar minus RFR bar divided by sigma M, 0.3, right? This is the Sharpe ratio for fund manager D. R bar minus RFR bar divided by sigma sub D. Do that for all of the funds. Here are the Sharpe ratios. Remember, we want our Sharpe ratio to be as high as possible. So it looks like fund manager E on a relative basis, relative to the other portfolios, performed the best on a risk-adjusted basis. By dividing by sigma here, we are risk adjusting, right? So when you divide by total risk, you are risk adjusting. All right, here we have the CML. Remember, that was the capital market line, right? And the reason we're having the CML here is because down here we're having sigma port, or standard deviation, which is total return, right? Total return is the relevant risk measure for the CML. Here we have the rate of return. Now, what did we do here? First of all, by design, the Sharpe ratio of the market portfolio, right, plots directly on the CML. Remember that the market portfolio theoretically has all risky assets in it, so it's completely diversified. And we learned in a previous chapter that all portfolios along the CML are completely diversified, right? There is no unsystematic risk in those portfolios. All right, so that's the Sharpe of the market. The Sharpe ratio for fund manager E and F on the previous slide were both higher than the Sharpe ratio for the market. Fund manager D had a lower, right, a lower Sharpe ratio, right? So if we were ranking these, fund manager E would be first place, relatively speaking. Fund manager F would be second place. The market portfolio, I guess we could give that third place. And then fund manager D would be fourth place. And we would also say that fund manager D here, according to the Sharpe technique or the Sharpe ratio, underperformed the market on a risk-adjusted basis. Fund managers E and F outperformed the market on a risk-adjusted basis. So Traynor came along, right, in the neighborhood of time, like 1965, around the time Sharpe was developing his, shortly thereafter. He postulated there were two components to risk, and we've talked about them, and it's very easy in modern times to talk about these things as if, oh, it's no big deal. Well, it was a big deal back then when they were being developed. There's risk produced by general market fluctuations like interest rates, unemployment, GDP, recessions, things that none of us can hide from. And then there's risk resulting from unique fluctuations in the portfolio securities, the individual stocks in the portfolio, right? We know that that type of risk can be diversified away. That's company-specific risk, right? So Traynor introduced the characteristic line. That was, I don't know if I called it that, but you may have read the verbiage on the slide. When I was talking about running a regression using historical data to come up with a stocks beta, remember my adult version question, where do betas come from? Right? It was when I was talking about that in a previous chapter. That regression equation is called the characteristic line. And from that, we get the slope, which is the beta coefficient, right? And so Traynor introduced the risk-free asset, right, which then led to capital market theory and showed that rational investors would always prefer the portfolio line with the largest slope. We always want more return per unit of risk, and that's what the slope is. So here is the Traynor measure. Looks very similar to the Sharpe measure, except we got T here instead of S. That's the average return to fund I during some historical time period minus the average return to the Treasury bill during the same historical time period. Now we're not dividing by total risk, we're dividing by beta, which measures only systematic risk, right? So market types of risk. Right. That's the difference. Again, this is going to give us a number. We want our Traynor measure to be as high as possible, right? And we then can rank funds relative to one another. These trainer measures will now plot on the SML graph, right? Because we're using beta as our risk measure, which is systematic risk. And if you remember from capital market theory, when we developed the SML, the x-axis was labeled risk. It was measured by beta, systematic risk, not sigma. All right, so what is this? This is the trainer measure for the market portfolio. That's T sub M. This M right here is way too big. Someone got excited with the capital M key. You can make it the subscript if you want. It should look just like that, right? So R bar sub M, that's the average return on the market portfolio, minus the average return on the treasury bill during the same time period, divided by the beta of the market portfolio. Remember, you've probably heard this in a few classes. The beta on the market portfolio equals 1, right? Or the market's beta is 1. I know you've heard it in my class if you listened to me in a previous chapter. Okay, I would rewrite this as R bar sub M was 14%. We were given that even before the Sharpe discussion, right? RFR bar was 0.08. We were told that also before the Sharpe discussion. We're deciding between 3 different portfolio managers, right? We want to figure out who performed the best and then maybe who was the loser, right? So fund manager W, X, and Y, these are their R bars. That's R bar sub W, R bar sub X, R bar sub Y. And this is beta sub W, beta sub X, and beta sub Y. Right. Looking at those 3 betas, it appears that portfolio Y was the riskier of the 3. All right, so on this slide, we are simply computing the trainer measures or the trainer ratios for the portfolios. We're starting with the market portfolio. R bar minus RFR bar divided by beta. All right, so that's how we compute the trainer measures. Let's look at the trainer measure for fund manager X. The average return to portfolio X was 16%, minus the average return to the treasury bill was 8%, divided by the beta of fund manager X portfolio. Right? We want this number to be as high as possible. So who is clearly first place? That's fund manager Y. Who is second place? Fund manager X. Then we have the market. So what we could conclude is that since these 2 trainer measures are higher than the market's trainer measure, these 2 outperformed the market on a risk-adjusted basis, right? Then this is last place, the trainer measure of W. W does not stand for winner. W here stands for loser. Fund manager W's portfolio underperformed the market on a risk-adjusted basis. And again, we would plot all of these in the SML space. And the trainer of the market portfolio, by definition, plots directly on the line. Okay, here are the trainer measures plotted for the 4 portfolios. As promised, the trainer for the market portfolio plots directly on the SML. Beta is our relevant risk measure for the SML. Rate of return is over here. These 2 trainer ratios are above the line. They outperformed the market on a risk-adjusted basis. Fund manager W is not getting a bonus. They're probably getting a stern talking to, and hopefully this was the first time they underperformed the market on a risk-adjusted basis. All right, Jensen's alpha, right? The other 2 that we just talked about, the Sharpe ratio and the trainer measure, they come up with relative rankings, right? Relative, not absolute rankings, right? We don't know if those are, absolutely the clear winner, but we do know relative to the subset of portfolios that we were looking at, we can rank them relative to one another, which is what we did and which is what you will do at end of chapter problems and on any graded assignment. This approach, this one is the best from a researcher standpoint because it allows us to test for statistical significance, right? Now, I know those 2 words together, statistically significant, is not the typical student's friend because it's stats jargon. but it allows us to be more precise using data and hopefully getting as unbiased results as possible. Jensen in the late 1960s came along and said, let's use the CAPM, right? And so if you look over here, remember what this was called? This was called the market risk premium. It was in the CAPM. So was beta. So all of this looked the same, right? This was RFR, right? But if we subtract RFR from both sides, we will get this version. And if you remember from a previous chapter, if we take the return on risky portfolio J and subtract the T-bill rate, we get what is called excess returns, EXCESS returns, right? So this is the CAPM version, right? Before time marched on and people got more sophisticated. So this approach can also work for, and it does work for, the Fama-French three-factor model. So you'd have this term here, plus you'd have another beta, but you'd have SMB. Remember SMB was small minus big. That captured the size effect in stock returns, plus another beta times HML. Remember HML was high minus low. That was the value versus growth risk factor in the Fama-French three-factor model. You could also tack on plus another beta times MOM. Remember MOM? That stood for stock return momentum. So this can be expanded. This was the first version Jensen used in '68 because the only thing we had was the capital asset pricing model that had been developed at that point in time. So what we would do is we would take the excess returns for some fund J, some risky portfolio J, over, let's say, the last 10 years, right? You'd put its return here, you'd subtract the treasury bill during the same time period. We would have that, it would be known because the last 10 years would have happened. Then we would regress that on the S&P 500 index return during the same time period minus the treasury bill return during the same time period. Run a regression and out would pop this called the slope coefficient, the beta, right? This is what we're interested in here though, this alpha. If this alpha turns out to be a positive number and it's statistically significant, then we would say that fund manager J outperformed the market on a risk-adjusted basis, and they should get definitely a trophy. People on Wall Street would rather have money, so maybe a bonus, right? So down here it says, alpha indicates whether the portfolio manager is superior or inferior. In my example, I said if that's positive and significant, they are an all-star. If that turns out to be negative and significant, it means that their portfolio that they're actively managed underperformed the market on a risk-adjusted basis. Right? Down here it tells you exactly that. Superior manager has significant positive alpha, while an inferior manager's returns consistently fall short of expectations based on the CAPM. I'm sure in modern times that they're not going to use the word superior and inferior in the workplace anymore. They're probably going to say, you're a winner and you're not a winner. I could tell you what would happen in Dr. Bray's office, but we wouldn't have HR. All right, let's move along. All right, so to use the Jensen's measure, it says the Jensen's alpha measure of performance requires using different risk-free rates, right? Different treasury bill rates for each time interval during the sample period. That's right. You want to make sure that you're aligning things in calendar time so it's fair when you're running the regression. Right? It does not directly consider the portfolio manager's ability to diversify because it calculates risk premiums in terms of systematic risk. So we're actually assuming that these portfolios are diversified. The Sharpe measure allows for the probability that the portfolio isn't completely diversified because remember the Sharpe ratio in the denominator has sigma, which is total risk. Right? The Jensen's performance measure is flexible enough to allow for other models, right? That was my discussion I had about the Fama-French three-factor, four-factor models. And so you would plug and chug. This equation here doesn't really help you for examination or quiz purposes, so you don't necessarily have to put that on there. Okay, you notice that I removed the slides completely for the information ratio. I told you it was going bye-bye, and it did. So here's the last one, the Sortino measure, right? This one's similar to the other ones, except with a couple modifications that we will now discuss, right? So the Sortino measure is a risk-adjusted performance statistic, differs from the Sharpe ratio in two ways. It measures the portfolio's average return, right, in excess of a, get this, user-selected minimum acceptable return threshold. So the person doing the analysis of the portfolio performance decides, what do you want to subtract there in the numerator? Remember, it's R bar, the average return on the portfolio, minus, in the Sharpe ratio in the trainer measure, it was minus RFR bar. So that was the average treasury bill rate during the time period. Here, they're saying, well, if you think there's something better than the treasury bill rate to put there in the numerator, do it, right? Just make sure you have like a reasonable explanation for, who you're explaining the results to. In this class, just know that your professor will probably hand you something that goes there. So user selected minimum acceptable to return threshold, that's going to be a Greek letter tau here in a moment. Often uses the risk-free rate, right? But it doesn't have to be the risk-free rate. The Sharpe measure focuses on total risk, right? Remember the Sharpe ratio in the denominator divided by sigma. That's total risk. Effectively penalizing the manager for returns that are both too low and too high. If total risk is the entire distribution, the total volatility of returns, in investments, I don't think there's anything that would bother me called a too high of a return. If it's way up there in the right-hand tail of the distribution, awesome, that's where I want my returns to be. So what Sortino said was maybe we should focus only on the downside risk, right? The returns that are below the average return. Those are the ones we want to stay the hell away from, and I agree with Sortino. Right? So the Sortino ratio captures just the downside risk, DR. That's downside risk, not Dominican Republic. All right, this ST may appear that we put the Sharpe and the trainer together. That is not right. ST stands for Sortino. They gave each syllable in his name its own capital letter. Cool. So Sortino measure is the average return to a risky portfolio I minus tau. Remember the tau is that minimum acceptable return threshold divided by the downside risk measure. And so we'll have to come up with that. So we're dividing by we're only going to include the returns in the downside risk measure that fall below the average. And we'll do that. All right. So downside risk, that's the scary stuff. It's the low returns. It's the returns below some hurdle rate that the investor chooses. This is how we will compute it. So semi-deviation equals square root 1 over n, right? The summation of all returns that are less than the average return. So you see this? We're only including the returns in the sample that are less than R bar, the average return. So we won't include all returns in this computation for semi-deviation, right? DR comes closer than measures of total risk to capturing what investors truly consider risky, right? Again, returns above the average, that's what the hell I want. I want high returns as much as possible, right? So this is what we're now going to do, and we'll follow this mathematically. Okay, so here is the example. It says, suppose over the past 10 years, so we have historical data, 2 portfolio managers, right? They're calling it Fund Manager A and Fund Manager B, have the following return. So this is historical data. In year 1, Fund Manager A lost 5% for their investors. In year 8, Fund Manager A gained 8% for their investors. That's how you read this table. All right, if we add up 10 numbers and we divide by 10, we will get what is called the average. I would label this R bar sub A. Right? The average return to Fund Manager A's portfolio during this 10-year period was 4% per year. Same thing, add those 10 numbers together, divide by 10, you get R bar sub B. Right? R bar sub B is 4%. That means that fund manager B's portfolio over the same 10-year period returned on average 4% per year. All right. They've computed the standard deviation for you, right? So this is sigma sub A, that's total risk, and sigma sub B, that's total risk. You might be going, well, why are we doing total risk? You just told us that Sortino does only downside risk. You're right, but we're comparing the two approaches. Sharpe uses total risk. That's why they gave you standard deviation here, sigma and sigma. So if you go back to the previous slide where they gave you standard deviation at the bottom, that standard deviation computation for the Sharpe method used every single one of those returns, all 10 years of returns for fund manager A and fund manager B in that computation for sigma, standard deviation. Sortino says, nope, only include those returns out of those 10 that are below the average return, right? So R bar A, right? You would look at that and you would say, okay, well, that number, I need to only include the numbers that are less than that. So the R bar A on the previous slide was 4. So we look in that column in the textbook or on the previous slide, right? And you include only the returns that are less than 4. -5 is less than 4. So you follow the formula for DR, right? That was a return minus R bar A. Square it. -3 gets included because it is less than the average return of 4%. So does -2, so does 3 and 3, right? All 5 of those, and those are the only 5 returns during that 10-year window for portfolio A that were less than the average return, right? So you follow the formula to a T. When you add all these up and you divide by 5, that's the same thing as multiplying all of this by 1/5. You get 5.8. So this is the downside risk measure for fund manager A. Do the same thing for fund manager B and you'll get 4.82, right? So now it looks like fund manager A presented the more risk to their investors than fund manager B when we only include the returns that are less than the average return. If you have the slide from the last slide in front of you, look at the standard deviations, which measure total risk. If you look at that, it appears that fund manager B presented the most risk, right? So that reversed when you look at only returns below the average return. And when you do that, here is the ordering, right? It says assuming a minimum return threshold of 2%, that's tau, right? So we're going to put it right where tau goes in the formula, minus tau, minus tau. Right. Let's see. Sortino ratio for A equals 0.345. That's the answer. It's not multiplied by this. Look, it looks a little crazy. Sortino ratio is 0.345. Sortino ratio for fund manager B is 0.415. We want this number to be as high as possible. That's the same. So it looks like fund manager B did better than fund manager A, right? Up here it says the manager of portfolio B was actually the superior performer. Let's make sure we know where these numbers are coming from. R bar A was 4, and so was R bar B, right? Minus tau divided by DR for the two funds. So fund manager B was superior to fund manager A using the Sortino ratio. With any performance metric in any discipline, there are pros and cons to each one of them, right? And so I think Exhibit 18.7, they're going to show us, list some of these things. Okay, you can read through this if you want. I'm not going to spend any time on this except to tell you to get rid of this one completely. When you're studying, we are not doing the information ratio.